Well, good morning, everybody. Thank you, Keith. Pleasure to be here. We're an oil and gas company. We're out of Calgary. All of our assets are in Alberta and Saskatchewan. We used to have a company called Gentry Resources. Keith talked about one of my directors, Mike Halverson. Mike's been with me for 15 years. We sold Gentry in late August of '08 for just about $300 million. We started that company at 22 cents, and we sold that company at $4.27. And so it's a great success story. And we started this company, Novus. Novus is a recap. We started it in, its first financing was March of '09, and we got control of the board in June of '09. Fully diluted shares, you can see, is 212 million shares. Our market cap's 157 million. Enterprise value about 205 million. We are a very good trader. You can see we average 1.4 million volume a day. For a company our size, with market cap our size, we're a very active trader. Credit facility, we've always banked with National Bank. I banked with them with my predecessor companies, and so we have a terrific relationship with National. That 65 million credit facility is going to be increased shortly here, so you'll see that. Net debt, 48 million. Tax pools, 240 million. One of the reasons we sold Gentry back in '08, it was a very highly successful company. We were making $12 to $14 million a month, and we were paying the tax man a lot of dough. So when it was cash taxable, and that was one of the reasons we sold. The other reason was WTI at that time was 140 bucks, and that's one of the reasons we got a big price for our company. Our average production for Novus this year is going to be 3,300 barrels a day. Exit production is going to be 4,500 barrels a day. We are 85%, as Keith said, leveraged to oil. Oil is where you want to be because you have high netbacks. Gas right now is $3 an MCF. Very, very difficult to be an economic company if you have a lot of gas. Reserves this year are 8 million for proved reserves and just under 15 million for proved plus probable reserves. Again, we're 82% leveraged to oil. We're going to spend a whole bunch of time today talking about our Dodds Land, Viking lands. These are located in southwest Saskatchewan, and that's the core area, and that's the whole reason of our explosive growth is because of Dodds Land, Saskatchewan. We issued a press release 3 weeks ago, talked about some other lands, also Viking lands. Viking is the formation that's 750 meters deep on the other side of the border in Alberta. And we've been buying land for the last year, and we're pretty proud of buying these 46 sections of land, and we continue to grow these lands in Alberta, and we'll get to that in a little bit. And then the key takeaway at the bottom of the slide, the Dodds Land Viking drilling locations, we have over 600 locations to drill. This is our Q2 that we issued in June 30th of this year. You can see we did, production was 2,800 barrels a day, up from 13 from the prior year, 119% growth. Oil production, 22 from 800, 155% growth. Cash flow, 8.6 compared to 3, just under 200% growth. Operating netbacks, that's key. We're going to spend some time on our netbacks. And operating costs, we're one of the lowest operating cost junior oil companies in the business right now. And out of all of our peers, which is about 30 companies, I think we rate 4th for our operating netbacks. So we've continued since our company's only 3.5 years old. We've always increased our production. We've increased it on a per share basis, and that's what all you people should be concerned about. It's easy to grow a company, but if you keep diluting your stock, it's very important to grow a company on a per share basis. And our operating costs are really low, and that helps your netback. So it's all about netbacks in our business. P plus P reserves. So we had a third-party engineer evaluate our reserves like every public oil company does. So at the end of December last year, they said our reserves were worth $330 million. Our land was $32 million. Net debt at that time, 48, which is where we are right now. So our net asset value was $340 million, $350 million. Fully diluted shares, 212. So our net asset value at that time is $1.64. We're currently trading today at 80 cents a share. When we started this company 3 years ago, the market cap of the company was $4 million. And we've only done 2 equity raises. The last equity raise was March of 2010. And this gentleman that just came in, Sherman Dahl with National Bank, has helped us in all of our financings. So we just want to show you how we've grown since we've started this company. It's when we took this thing, it was a recap, as I said. It was in financial difficulty. The market cap at the time was $4 million. It had 300 barrels a day of production. Today, we're in excess of 3,400 to 3,500 barrels a day today. So we've done a 10-bagger of our production growth in 3.5 years. Again, I said per share is important. You can look at the per share numbers. When we started this company, it was leveraged 26% to oil. We are now going to be leveraged 84 to 85% oil. Operating netbacks were a whole $7 when we took it over, And this year we're going to average 53, and if WTI keeps going higher, we'll get closer to $60 for our netbacks. Pretty material compared to $7. And P plus P reserves, you can see we've really grown our reserves over time, and this year when we issue our December 31st this year, again, there'll be significant reserve growth. This just is showing you that we've grown our company since we've started it on an absolute basis and on a per share basis. The top line chart is your daily production per million shares, and then the bars are just showing you how we've grown our company. So that's reserve growth, same thing. We had 2.5 million barrels of reserves at the end of last year. We had just under 15 million barrels of reserves, and we're going to grow significantly again this year, and materially again on a per share basis. Next is our cash flow. Cash flow is king in our business. It should be king in everybody's business. You can see when we took the thing over, it was losing money. In 2010, it made cash flow was a whole $4 million, and this year we're going to do $52 million of cash flow, and on a per share basis, that's 27 cents compared to 15. So pretty significant growth. We're happy about where the chart is taking us. So this is a map of our Dawsland play. It's kind of tough to see, I apologize, but it's a big play. It's 90 miles long and it's 60 miles wide. It's just over the Saskatchewan border. I'm just going to show you this next picture. I just want you to know, if you are in our play and if you lose your dog, you will find your dog. It's very flat. There's no trees. And this is what our property looks like. And if you're on this picture, as far as the eye can see, this is our lands. And as I said, this play is 90 miles by 60 miles. A lot of the who's who is in this play. We have Talisman that just entered the play, the most recent entrant. Before that was Devon. Devon just drilled 20 wells last year. Husky's in the play. Baytex is in the play. Crescent Point is in the play. Enerplus is in the play. We are the second biggest driller in the play, and it's pretty impressive when we have all of these big companies that we're competing with. We have one of the largest land positions out of a junior oil in this play. This is the most amount of wells drilled in a resource play in Canada is in the Viking play, which is our play. We were an early entrant in this play, which was late 2009. We spent 2009 and all 2010 acquiring our land position at very attractive levels. The play blew open at the end of 2010 and early 2011, and you still have new guys coming into the play as we speak. There's been over 1,100 Viking wells drilled in this play so far, the most in any other play, way more than the Cardium, way more than the Bakken. We love the play because it's an easy play to figure out. It's shallow, 750 meters. It costs you $400,000 to drill a well. It costs you $450 approximately to complete a well. And to get on stream, all in is $930,000. Again, great area to work. You know, a lot of our competitors have to work in Alberta and northern Alberta, and as you know, there's an awful lot of trees, and there's an awful lot of foothills, and there's an awful lot of mountains, and an awful lot of roads. All of the farmers here are shareholders. We have about 11 farmers, and all of them own a lot of our stock. Every one of those farmers, we've fixed some roads up for them. They've taken us out there and we've herded some of their cattle, and we've got great relationships with the farmers, and it's a real easy place to work. This is a typical horizontal type curve. So the top of that curve is what Sproul Energy that's their type curve, our engineers, that's telling you what our wells will do. Well cost $930,000, recoverable reserves 51,000 barrels, 1 month IP 52 barrels a day. You get your money back in 1.5 years. That's on the whole of our play. We have a real hot spot in our play called Flaxcomb, which is on the left-hand column of the map. Same cost, $930,000 to drill this. Recoverable reserves are higher. They're 75 IP barrels a day, and you get your money back in approximately a year. This is a very, very good play to be in. Most payouts about 1.5 to 2 years, and if you're gas, it's 3 to 5 years. So we're real excited about the play. We had our third-party engineers tell us how much oil is in play, how much oil is initially in place in the ground. So they evaluate all of our lands, and they've come back and told us that we have 644 million barrels of oil in place on all of our lands. So then what you have to do is you have to use horizontal technology and go get that oil out. So we've got 11 million barrels of oil in place that our engineers have given us, and they said if we drill 12 wells per section, they'll give us another 11 million barrels. If we drill 16 wells per section, which we're starting to do now, we have a potential of 44 million barrels. Right now we have booked, as I showed you at the start of the presentation, 14 million barrels. Summary, we're a pure play, one play, Viking, easy to understand, it's repeatable. We've grown this company all organically. A lot of guys have to buy assets to grow. We've done it the old-fashioned way, which is the drill bit. We've increased our production on a per-share basis. We have low decline production, high netback, one of the highest in the industry. We have an inventory of over 8 years. We drill 80 wells a year. We've got a 10-year inventory, actually, not 8. And you don't have to take my word for it. We're one of the most well-covered companies on the street. I think we have 13 or 14 buy recommendations on us right now. The most recent buy recommendation was National Bank. For a company our size, you're not going to see a company our size have this many buy recommendations. And I'm over by 20 seconds, so come on up, Keith. Thanks very much.
Thank you, Hugh. Thank you. Thank you.